What if I told you that a sock puppet nearly bankrupted America? Stay with me here because by the end of this story, you'll understand how a cartoon dog advertising pet food became the symbol of the greatest financial disaster since the Great Depression. But here's the crazy part. This wasn't some random accident. This was a disaster that smart people saw coming, warned everyone about, and yet nobody could stop. $5 trillion evaporated in less than 2 years. That's more money than the entire GDP of Japan. Gone. Just gone. And the wildest part, we're probably building another bubble right now, making the exact same mistakes, just with different buzzwords. By the time we're done here, you'll see the warning signs everywhere. Let me start with something that sounds completely insane. In 1999, a company called Pets.com spent $12 million on a Super Bowl commercial. $12 million for a 30-second ad. Now you might be thinking, okay, they must have been making serious money to afford that, right? Wrong. They weren't just losing money, they were hemorrhaging it. For every dollar Pets.com made, they lost $2. Think about that. Every single transaction made them poorer. They were literally paying customers to shop with them. And Wall Street? Wall Street thought this was genius. The stock market valued this company that lost money on every sale, at over $300 million. But Pets.com wasn't even the craziest example. Not even close. There was a company called Webvan that wanted to deliver groceries to your door. Sounds normal now, right? But here's what they did differently. Before they had even proven the concept worked in one city, they raised $800 million and built distribution centers in 26 cities simultaneously. They bought a fleet of delivery trucks. They hired thousands of employees. They built custom warehouses with robotic systems. And they did all of this before figuring out if people actually wanted grocery delivery badly enough to make it profitable. The company burned through more than $800 million in less than 2 years. $800 million. That's roughly $2 million per day. Every single day. Until the money ran out and the whole thing collapsed, putting 4,000 people out of work instantly. Here's where it gets even more insane. The people funding these companies weren't stupid. These were some of the smartest investors in the world. People from Harvard, Stanford, MIT. People who had built successful companies before. And they all bought into the same delusion. They all believed the same thing, that the old rules didn't apply anymore, that profitability was a quaint, outdated concept, that in the new internet economy, the only thing that mattered was growth. Get big fast, worry about money later. Except later never came for most of these companies. Let me paint you a picture of just how crazy things got. In 1995, the NASDAQ index, that's the stock market index that tracks tech companies, was at about 1,000 points. 5 years later, in March of 2000, it hit 5,000 points. That's a 400% increase in 5 years. To put that in perspective, that's like your savings account going from $10,000 to $50,000 in 5 years, without you adding a single penny. Sounds great, right? Here's the problem. It wasn't based on anything real. These companies weren't making 5 times more profit. Most weren't making any profit. The prices were going up simply because people believed they would keep going up. It was a self-fulfilling prophecy, until it wasn't. Now, before we go deeper, you need to understand how we got here, because this didn't happen overnight. This was a perfect storm of historical timing, human psychology, and technological revolution, and it starts in an unexpected place, with the end of the Cold War. When the Soviet Union collapsed in 1991, something remarkable happened to the American economy. Suddenly, the United States wasn't spending massive amounts of money preparing for potential nuclear war. Interest rates dropped. Money became cheap to borrow. At the same time, personal computers were becoming mainstream. The internet was transitioning from a military and academic tool to something regular people could use. And then, in 1994, something happened that changed everything. Netscape launched its web browser. Now, Netscape itself is barely remembered today. But what Netscape did was revolutionary. They made the internet accessible. Before Netscape, using the internet required technical knowledge. You needed to understand command lines and protocols. Netscape gave us a simple point-and-click interface, Suddenly your grandmother could use the internet. And when your grandmother can use a technology, that's when it becomes truly mainstream. But here's where the story really begins. In August 1995, Netscape went public. This was an IPO, an initial public offering, where a private company sells shares to the public for the first time. The stock was priced at $28 per share. On the first day of trading, it closed at $58. It had more than doubled in a single day. And here's the kicker. Netscape had never made a profit, not a single quarter of profitability. The company was losing money. And yet on that first day of trading, Netscape was valued at nearly $3 billion. This should have been a red flag. This should have been a massive warning sign. A company with no profits, valued at $3 billion. But instead, it became a blueprint. Netscape's IPO showed everyone that you didn't need profits to make money in the stock market. You just needed a good story about the internet. And boy, did people have stories. Suddenly, everyone had an internet business idea. Want to sell books online? Brilliant. Want to sell pet food online? Genius. Want to sell furniture online? Revolutionary. It didn't matter that shipping a 50-pound bag of dog food to someone's house cost more than the profit margin on the dog food. It didn't matter that furniture has terrible margins and high shipping costs. All that mattered was adding .com to your business plan and watching the money roll in. Let me tell you about a company called theglobe.com. This was essentially an early social networking site, launched in 1995 by two college students. When they went public in November 1998, their stock opened at $9 per share. By the end of the first day, it closed at $63. That's a 600% increase in one day. The company was valued at $800 million. The two founders, both in their early 20s, were suddenly worth over $200 million each. On paper, at least. Here's the thing. Theglobe.com was losing millions of dollars every quarter. The company had no clear path to profitability. But none of that mattered, because everyone believed the internet was going to change everything. And you know what? They weren't entirely wrong. The internet did change everything. That's what makes this story so fascinating. The vision was right. The timing was wrong. These entrepreneurs were seeing the future, but they were trying to build 2024 companies in 1999, with 1999 technology and 1999 consumer behavior. Think about Webvan, the grocery delivery company I mentioned earlier. In 2024, grocery delivery is normal. Companies like Instacart and Amazon Fresh do it successfully. But in 1999, most people didn't have reliable internet access. Many didn't even have email. Credit card transactions online were new and scary. The infrastructure for efficient delivery routing didn't exist. GPS wasn't in every phone because smartphones didn't exist yet. The technology and consumer habits needed to make grocery delivery work simply weren't there yet. But Webvan's investors were so blinded by the potential that they ignored the present reality. Now here's where the psychology gets really interesting. There's a concept in behavioral economics called FOMO, fear of missing out. And during the dot-com bubble, FOMO reached epidemic levels. People who had never invested in stocks before were quitting their jobs to day trade. Ordinary Americans were taking out second mortgages to buy tech stocks. I'm not exaggerating. Financial advisors from that era tell stories of clients who refused to diversify their portfolios because they were making so much money from tech stocks. Why own boring stuff like bonds or blue-chip stocks when internet companies were doubling every month? There's a famous story about a taxi driver in Silicon Valley who quit driving to become a day trader because he was making more money trading stocks between fares than he was making from driving. Let that sink in. The economic incentives had become so distorted that it made more financial sense to gamble on stocks than to work a regular job. And the media fed into this frenzy. Magazine covers proclaimed, "Everyone's getting rich except you." TV shows like Mad Money made stock trading seem like entertainment. CNBC became the most watched cable news network because people were obsessed with watching their portfolios grow in real time. Books with titles like Dow 36,000 became bestsellers, predicting that the stock market would triple in value. Ordinary people started using terms like burn rate and eyeballs and mind share, as if these were real economic metrics. Let me explain these terms because they're crucial to understanding the insanity. Burn rate was how fast a company was spending money. A high burn rate meant you were losing money fast. But instead of being seen as a bad thing, a high burn rate was often viewed as a good thing during the bubble. It meant you were investing in growth. You were building market share. The faster you burned through investor money, the more aggressive you were, and aggression was celebrated. Eyeballs referred to website visitors. The logic was simple. If you could get millions of people to visit your website, eventually you'd figure out how to make money from them. It didn't matter if you had no idea how you'd make money. Just get the eyeballs, and the profits would follow. Somehow. This led to companies making completely irrational decisions. Pets. Com, for instance, famously sold 50-pound bags of dog food for the same price they paid for it, then paid for shipping on top of that. They were literally losing money on every transaction. But their logic was that they were building brand awareness and acquiring customers. The idea was that once everyone knew about pets, Com and had tried it, they'd become loyal customers, and then the company would start making money. Except that never happened, because selling products for less than they cost is not a sustainable business model, no matter how many customers you have. You can't lose money on every sale and make it up in volume. That's not how math works. But the most dangerous metric was something called mind share. This was the idea that if your company was the one everyone was talking about, you'd eventually dominate the market. So companies spent absurd amounts of money on marketing just to stay in the conversation. They bought Super Bowl ads they couldn't afford. They sponsored sports stadiums. They plastered their logos on buses and billboards, all to build mind share, all to make sure people were thinking about them. And for a while it worked. Not in terms of making money. These companies were still losing money hand over fist. But in terms of stock price, it absolutely worked. The more a company spent on marketing, the more visible it was. The more visible it was, the more investors thought it was succeeding. The more investors bought the stock, the higher the stock price went. The higher the stock price, the more money the company could raise by selling more stock. It was a beautiful, perfect circle of delusion. Now let me tell you about the venture capitalists, because they were the ones fueling this entire machine. Venture capital firms are companies that invest in early-stage startups, hoping that one or two will become the next Google or Amazon. During the dot-com bubble, venture capital funding exploded. In 1995, venture capitalists invested about $7 billion in startups. By 2000, that number had increased to over $100 billion. That's more than a tenfold increase in just 5 years. But here's what's crucial to understand. Venture capitalists weren't stupid. They knew most of these companies would fail. That's how venture capital works. You invest in 100 companies, expecting 90 of them to fail, 9 to do okay, and 1 to become a massive success that pays for all the failures. The problem was, they started believing that the 1 in 100 odds had somehow changed. They started thinking that maybe 50 companies would succeed, or 75, or all of them. They convinced themselves that the internet had changed the fundamental rules of business. There was a famous venture capitalist named Michael Moritz who worked at Sequoia Capital. He was one of the early investors in Yahoo, Google, and PayPal. Even he later admitted that during the bubble, they were funding companies they knew probably shouldn't be funded, but they did it anyway because they were afraid of missing the next big thing. They were afraid that if they passed on a company and it became successful, they'd look foolish. So they invested in everything, just to make sure they didn't miss anything. This created a toxic environment where due diligence, the careful analysis of whether a company is actually a good investment, basically disappeared. Venture capitalists would meet with entrepreneurs for 30 minutes, hear a pitch about how they were going to revolutionize some industry with the internet, and write a check for $5 million. Sometimes more. Sometimes they'd invest without even seeing a working product. Just a PowerPoint presentation and a charismatic founder were enough. And the entrepreneurs knew this. So they played into it. There was a formula to pitching during the dot-com bubble. You'd start by identifying some massive established industry, let's say the car industry, worth hundreds of billions of dollars. Then you'd say, we're going to bring this industry online and capture just 1% of that market. 1% sounds reasonable, right? But 1% of a $1 trillion industry is $10 billion. Suddenly your startup is potentially worth billions, even though you haven't made a single sale yet. This is how you ended up with companies like Kozmo. which delivered snacks and DVDs to your apartment in under an hour. For free, with no delivery charge. They raised $280 million from investors who somehow thought that delivering a DVD that rented for $3 while paying a courier to drive across the city was going to be profitable. It wasn't. Kozmo went bankrupt in 2001, having burned through all that money in about 3 years. Or consider Boo.com, a fashion retail website that was going to revolutionize online shopping. They raised $130 million before they even launched. When they finally did launch in 1999, the website was so graphics heavy that it took several minutes to load on the dial-up connections most people had at the time. The company spent money like it was infinite. The founders flew on private jets. They stayed in 5-star hotels. They had offices in multiple countries. When Boo.com collapsed in May 2000, they had burned through $130 million in just 18 months. That's over $238,000 per day. But perhaps the most telling story is that of eToys. This was going to be the Amazon of toys. They went public in May 1999, and on the first day of trading, the stock price went from $20 to $76. The company was suddenly worth almost $8 billion. To put that in perspective, Toys R Us, the actual physical profitable toy store chain that had been around for decades, was worth $6 billion at the time. So the stock market thought eToys, a website that had never made a profit, was worth more than the largest toy retailer in America. A company with warehouses full of inventory, hundreds of stores, thousands of employees, and actual customers was worth less than a website. This is when smart people started getting nervous. Warren Buffett, probably the most successful investor in history, refused to invest in tech stocks during this period. He said he didn't understand them and that the valuations didn't make sense. People mocked him. They called him old-fashioned, out of touch, past his prime. How could he not see that the internet was changing everything? But Buffett understood something that most people had forgotten, that eventually companies have to make money. Eventually the fundamentals matter. And then there was Alan Greenspan, the chairman of the Federal Reserve, basically the person who controls interest rates in the United States. In December 1996, Greenspan gave a speech where he used the phrase irrational exuberance to describe the stock market. He was warning that stock prices were getting disconnected from reality, that people were so excited about the future that they were ignoring the present. But you know what happened after that speech? Nothing. Well, not nothing. The stock market dipped slightly, then continued going up. Because if there's one thing humans are good at, it's ignoring warnings about things we don't want to believe. Throughout 1998 and 1999, there were more warnings. Established companies with real profits were being valued lower than internet startups with no revenue. Traditional metrics like price-to-earnings ratios, which measure how expensive a stock is relative to the company's profits, stopped making sense because most internet companies had no earnings. So analysts invented new metrics. They talked about price-to-sales ratios, ignoring whether those sales were profitable. They talked about network effects and first-mover advantage, as if being first automatically meant you'd win. Here's a perfect example of the insanity. In 1999, a company could literally add .com to its name and watch its stock price soar. There was a company called CMGI, which was basically a holding company that invested in internet companies. At its peak, CMGI was worth over $40 billion, even though the companies it invested in were mostly unprofitable. The company's value was based entirely on the theoretical future value of its investments, which were based on the theoretical future value of the internet, which was based on, well, hope and imagination. The market reached its absolute peak on March 10, 2000. The NASDAQ closed at 5,048.62 points. It would not reach that level again for 15 years. 15 years. But on March 10, 2000, nobody knew this was the peak. People thought the market might pull back a little, sure, but then it would keep going up. The internet was the future after all. How could internet stocks not keep going up? And then reality arrived. Slowly at first, then all at once. The first cracks appeared when companies started running out of money. Remember, most of these companies were burning cash. They were spending more than they were making, sometimes much more. The plan was always to raise more money from investors before the current money ran out. But suddenly, in mid-2000, investors started getting nervous. They started asking uncomfortable questions. Questions like, when will you be profitable? And, how exactly does this business model work? Questions that should have been asked from the beginning. And the companies didn't have good answers. Because there were no good answers. Many of these businesses were fundamentally flawed. They were trying to do things that the technology and consumer behavior of 2000 simply couldn't support. In March 2000, Barron's magazine published an article titled, Burning Up. It analyzed the cash positions of 207 internet companies and concluded that at their current burn rates, 51 of them would run out of money within the next 12 months. 51 companies. And these weren't tiny startups. These were public companies, traded on major stock exchanges, worth billions of dollars on paper. The article was like someone finally pointing out that the emperor had no clothes. Suddenly, everyone started doing the math, and the math was terrifying. The sell-off started slowly. In March 2000, the NASDAQ dropped about 10%. People thought it was just a correction, a healthy pullback. Buy the dip, they said. It's a great opportunity, they said. But the dip kept dipping. April was worse. May was even worse. By the end of 2000, the NASDAQ had fallen from over 5,000 points to under 3,000. That's a 40% decline in less than 10 months. But it kept falling. 2001 was worse than 2000. 2002 was worse than 2001. By October 2002, the NASDAQ bottomed out at 114 points. From the peak in March 2000, it had fallen almost 78%. 78%. That means if you had invested $10,000 at the peak, you'd have about $2,200 left. You'd have lost almost $8,000. But those are just abstract numbers. Let me tell you what this looked like in real life. Pets.com, the company with the sock puppet, shut down in November 2000. They had spent $300 million in less than 2 years. The sock puppet costume was auctioned off for $22. Webvan filed for bankruptcy in July 2001. $800 million gone. 4,000 people lost their jobs. The custom delivery trucks were sold at auction. The automated warehouses were dismantled. eToys filed for bankruptcy in March 2001. That $8 billion valuation had evaporated. The company's assets were eventually sold to KB Toys for $5 million. From $8 billion to $5 million. Let that sink in. Kozmo. Com shut down in April 2001, laying off all 1,100 employees with almost no notice. Employees showed up to work one morning and were told the company was closing immediately. Boo. Com collapsed in May 2000, having spent $130 million in 18 months. The Globe. Com. Remember that one? The social networking site whose stock went up 600% on the first day? The company never made a profit. The stock, which had hit $97 per share, fell to 7 cents per share. 7 cents. The company was eventually delisted from the stock exchange and ceased operations. But it wasn't just the obvious disasters that failed. Even companies that seemed legitimate, that seemed like they might actually work, collapsed. There was a company called Exodus Communications that provided web hosting services. This was actually a real business with real revenue. But they had expanded too aggressively, taking on massive debt to build data centers around the world. When the dot-com collapse happened, their customers couldn't pay their bills, and Exodus went bankrupt, wiping out $5 billion in market value. The human cost was staggering. By some estimates, over 1 million jobs were lost in the tech industry between 2000 and 2002. And these weren't just abstract job losses. These were real people who had moved to Silicon Valley or San Francisco, lured by stock options that were now worthless. They had uprooted their lives, relocated their families, taken on expensive Bay Area rents and mortgages, and now they were unemployed, often with skills that were suddenly not in demand anymore. There are stories of people who were paper millionaires. They owned stock options in companies that were worth millions on paper, but that they couldn't sell yet due to vesting periods or lockup agreements. And then the companies collapsed, and those options became worthless. People who thought they were set for life found themselves with nothing. Silicon Valley went from having the lowest unemployment rate in the country to having one of the highest. Office space that had been impossible to find suddenly sat empty. Luxury cars were repossessed. Expensive restaurants closed. The whole ecosystem that had been built around the tech boom collapsed, and the ripple effects spread far beyond Silicon Valley. Pension funds and 401k retirement accounts that had invested heavily in tech stocks saw massive losses. Ordinary Americans who were counting on those investments for retirement watched their life savings shrink. The total market capitalization lost from the NASDAQ crash was about $5 trillion. $5 trillion. That's roughly the entire annual GDP of Japan, the third largest economy in the world, just gone. Banks that had made loans to tech companies and tech workers found themselves with massive bad debts. Some failed, others had to be bailed out. The advertising market collapsed because all those dot-com companies that had been spending billions on advertising suddenly stopped spending. Media companies that had become dependent on that advertising revenue faced their own crises. And it wasn't just in America. The dot-com bubble was global. London, Tokyo, Hong Kong, Stockholm, every major financial center had been caught up in the frenzy. When it burst, the damage was worldwide. Now here's what's really important to understand. This wasn't just a story about bad companies. Some of the companies that failed actually had good ideas. Ideas that would later work, but they were too early. The technology wasn't ready. Consumer behavior wasn't ready. The infrastructure wasn't there yet. Think about Webvan. In 2024, grocery delivery works. Instacart is a successful company. So is Amazon Fresh. But in 1999, the pieces weren't in place. Internet penetration wasn't high enough. E-commerce infrastructure was primitive. GPS routing for delivery drivers didn't exist in any practical form. Credit card processing online was slow and expensive. Consumer trust in online shopping was low. Or think about streaming video. During the dot-com boom, there were multiple companies trying to stream video over the internet. They all failed because internet speeds in 1999 couldn't support it. Most people had dial-up connections that took minutes to load a single image. Streaming video was a fantasy. But 10 years later, YouTube became one of the most valuable companies in the world, doing exactly what those earlier companies tried to do. The vision was right. The timing was wrong. And timing, in business, is everything. So what were the real lessons from the dot-com crash? Because there are real tangible lessons here that apply to any bubble, any speculative mania, whether it's tech stocks or housing or cryptocurrency, or whatever the next big thing is. Lesson 1. Fundamentals matter. Eventually, always, companies have to make money. They have to generate more revenue than they spend. It's not old-fashioned or outdated to care about profitability. It's basic economics. You can ignore it for a while, especially in a hot market where investor money is plentiful. But eventually, the money runs out, and when it does, companies that can't support themselves die. Lesson 2. Being first doesn't guarantee success. This was one of the biggest myths of the dot-com era. Everyone wanted to be the first mover, believing that the first company to enter a market would automatically dominate it. But history shows this isn't true. MySpace was before Facebook, Yahoo was before Google, Pets.com was before Chewy. Being first is less important than being right, than having the right business model, the right timing, the right execution. Lesson 3. Growth without a path to profitability is just spending money. During the bubble, companies celebrated user growth without ever asking whether those users could be monetized. They celebrated revenue growth without asking whether that revenue was profitable. Lots of businesses can grow if you're willing to lose money on every transaction. That's not impressive. What's impressive is sustainable, profitable growth. Lesson 4. Narrative matters, but it's not enough. The dot-com companies had compelling stories. They were going to change the world, revolutionize industries, make everything faster and better and cheaper, and some of those stories were true. The internet did change the world, but a good story isn't enough. You need a good story, and a viable business model, and good execution, and the right market timing. Lesson 5. When everyone tells you this time is different, it probably isn't. Every bubble in history has been accompanied by the belief that old rules don't apply anymore. That we've entered a new era where traditional metrics and traditional wisdom are obsolete. In the 1920s, people said stocks could only go up because American industry was entering a new age. In the 1980s, people said Japanese real estate prices could only go up because Japan's economy was fundamentally different. In the 2000s, people said housing prices could only go up because they weren't making any more land. And in the late 1990s, people said internet companies didn't need profits because the internet was a paradigm shift. Every single time, this belief was wrong. Lesson 6. Cheap money creates dangerous incentives. The dot-com bubble happened partly because interest rates were low and money was easy to borrow. When money is cheap, investors start looking for higher returns, which means taking more risks. When money is expensive, people are more careful about where they invest it. There's a reason that most financial bubbles happen during periods of easy money and low interest rates. Lesson 7. Euphoria is a warning sign, not a validation. When everyone is excited, when it feels like you're missing out if you're not participating, when people are quitting their jobs to day trade or start companies, that's not a sign of a healthy market. That's a sign of a bubble. Sustainable growth is steady and boring. Bubbles are exciting and euphoric, and then they pop. Now here's the uncomfortable part. We might be in another bubble right now. I'm not going to predict the future, but look at the warning signs. Look at companies being valued at billions of dollars before they're profitable. Look at the excitement around new technologies like AI, where every company is rushing to add AI-powered to their product descriptions. Look at the venture capital flowing into startups based on compelling stories rather than proven business models. Look at regular people on social media giving stock tips and claiming to have discovered the secret to getting rich quick. Does this sound familiar? It should, because we've seen this movie before. After the dot-com crash, there were some good outcomes. The internet didn't go away. The companies that survived, Amazon, eBay, Google, became stronger. The infrastructure built during the boom, fiber optic cables, data centers, payment systems, didn't disappear. It became the foundation for the actual internet revolution that followed. The vision of the dot-com entrepreneurs wasn't wrong. It was just premature. But here's what troubles me. We didn't really learn the lessons. In the mid-2000s, we had a housing bubble that followed the same pattern. Easy money, irrational exuberance, the belief that prices could only go up, the abandonment of traditional lending standards, the creation of new metrics to justify insane valuations. And it crashed in 2008, nearly taking the entire global economy down with it. And now? Well, now we have cryptocurrency, NFTs, meme stocks, SPACs, special purpose acquisition companies that raise money before they even decide what business they're going to be in. We have disruptive startups that lose money on every transaction but claim they're building market share. We have apps being valued at billions of dollars based on user numbers rather than revenues. We have a new generation of investors who've never experienced a real bear market and think that buying the dip always works. I'm not saying all of these things are bubbles. Some of them might be the real deal, but the patterns are eerily similar to 1999. The psychology is the same, the narratives are the same, the metrics are the same, and history suggests that when we ignore fundamental value for long enough, reality eventually reasserts itself. The dot-com crash wasn't just a tech story. It wasn't just a Wall Street story. It was a human story about ambition and greed and fear and hope. It was about people who saw the future clearly but misjudged how long it would take to get there. It was about investors who abandoned discipline in pursuit of quick riches. It was about an entire society that convinced itself that the old rules no longer applied. And the scariest part? We keep doing it. Every generation thinks they're different, that they're smarter, that they've learned from the past. But the fundamentals of human nature don't change. We still get excited by new technology. We still experience FOMO. We still want to believe that we can get rich without doing the hard work of building real value. The dot-com bubble wasn't an anomaly. It wasn't a one-time mistake. It was human nature colliding with financial markets, and it's a pattern that repeats throughout history. Tulip mania in the 1600s, the South Sea bubble in the 1700s, railway mania in the 1800s, the roaring 20s and the 1929 crash. the Japanese asset bubble of the 1980s, the dot-com bubble, the housing bubble, and whatever's next. Understanding the dot-com crash isn't just about understanding a piece of history. It's about understanding yourself. It's about recognizing the warning signs when you see them in your own time. It's about having the discipline to say, this does not make sense, when everyone around you is getting rich. It's about being willing to miss out on the euphoria if it means avoiding the crash. Because here's the truth. The people who made real money from the internet weren't the ones who got caught up in the bubble. They were the ones who built sustainable businesses after the crash. Jeff Bezos nearly lost everything when Amazon's stock crashed from over $100 per share to $6 per share. But he kept building, kept focusing on fundamentals, kept executing. And Amazon became one of the most valuable companies in the world. The real winners weren't the ones who tried to get rich quick. They were the ones who played the long game, who ignored the hype and the FOMO and the pressure to abandon their principles, who remembered that business is about creating value, not just creating excitement. So the next time you see a company being valued at billions of dollars despite losing money on every transaction, ask yourself why. The next time someone tells you, this time is different, be skeptical. The next time you feel FOMO about missing out on the next big thing, remember that the fastest way to get rich quick is usually the fastest way to go broke. The dot-com bubble burst over 2 decades ago, but its lessons are timeless. Because bubbles aren't really about technology or markets or economics. They're about human psychology. And until human nature changes, we'll keep making the same mistakes, just with different names and different buzzwords. The sock puppet was just a symptom. The real disease was believing that we could build castles on clouds and call them businesses, that we could ignore reality and fundamentals and sustainability because we were living in a new era, that the rules that governed every other business in history somehow didn't apply to us. But gravity always wins. Math always wins. Reality always wins. And the $5 trillion that evaporated from the stock market was the price of learning that lesson. Again, the question is, what will it cost us to learn it next time?